Good afternoon. Thanks for letting me substitute for Claire Farley. She is attending a funeral for a good friend of hers, David Scheibel, who many of you know and respect, who passed away this weekend. So I'm her stand-in, so to speak. The premise that I'm going to talk about is how the game is really changing for the major oil companies and what that really means across the rest of the industry and how the industry and the environment might react to that. The majors historically have been the source of what I'll call the global leadership in terms of finding new reserves, developing new technology, applying that technology for recovery improvement, and really fundamentally managing really large, long lead time, complex projects, particularly in host countries that don't have that inherent capability. And that was kind of the role of the majors. They really developed the industry, through the 30s, 40s, and 50s, and 60s on that premise. But their access to the kind of opportunities they need to sustain their size and actually, grow at all is starting to shrink. And the dollars that are being spent by them on research in real terms have decreased and have not come back to historic levels really for about 10 years. The other thing is that the host governments, as we all know, are starting to put new demands on everyone working in their countries, and that's having a profound effect on companies like Chevron and others. The opportunities that they're pursuing are changing as well. There's, of course, there's great opportunities in the deep water. Tom talked a little bit about the oil sands, and then technology applications to stranded gas, LNG being very straightforward, but now as worldwide energy prices increase, much more exotic types of opportunities for stranded gas are beginning to look viable. But all of those opportunities that I just mentioned are very long lead time, very capital intensive, and very, very manpower intensive. And for the major oil companies, they historically, because of their size and because of the kind of long lead times they have, they need to look at a downside price scenario. And this will sound humorous or stupid in light of what's going on in the current commodity market. But they'll run downside oil price scenarios in the $40 to $50 range on some of these long lead time projects and try and see if make them viable at those kind of prices. Now you can argue about their logic of doing that, and they need to get with the new reality. But the fact is, when you think about the volatility on the natural gas side, how fast it went up and how fast it went down, how fast it went up, just over the last 12 months or 18 months, you can start to get a sense of why their planning mindset is like that. And also because of what Tom mentioned, it feels like, oil in the short term could bounce, to $120 and could trigger the demand elasticity, the demand response. So their history, particularly in the late 70s and early 80s and mid 80s, of going through all that, all the executives are kind of my age and slightly older. In other words, they lived through that. And so they have built in this planning function that runs these sensitivities at that level, and they're looking for returns, that work. So what's happening is that the leadership for developing those incremental supplies, that I talked about, is really shifting away from the major oil companies. A little bit in part because they can't deal with the current reality of commodity prices and where they're headed. They just can't function on that kind of a planning horizon. And the large independents are stepping in with some of their capital programs. The private capital is dramatically stepping in, and the host governments are starting to reach out and, I don't know what you call a leadership role, but they're taking a bigger role in terms of, what is their share. This last point should really give us some pause because, can we really look in the future to Saudi Arabia, Iraq, Iran, Mexico, Venezuela to make the kind of necessary investments as NOCs to really meet the perceived supply gap that exists and is coming. Let me go ahead and make the case on a number of these points with some of the slides. This first slide is total energy demand, includes obviously coal, nuclear, gas, oil, and others. There is, the first thing you'll see, because it's about a 22-year forecast, there's a wide range on all the forecasts. The thing is, when you look at those individually, they're all very, very plausible. And so what does that fundamentally mean? It means that there is a lot of variability about what could happen. So when you think back about the way the majors run kind of their downside price scenarios, it makes sense that they would run that kind of a price scenario when you look at these projects that don't come on until 2015, 2018. There is a 121 million barrel a day increase in the midpoint of those curves in 2030 between current energy usage and the 2030 energy usage. That's a 60% increase over today's fundamental demand. And like I said, 2030 seems like a long way off, but hardly relative to the kind of projects we're talking about to have a material impact on supply. Deepwater Gulf of Mexico, nearly every project I've looked at for the last couple of years doesn't start before 2014 is very early. 2015, 2016, and those are for existing discoveries many times. For things that just went in the recent lease sale, you're probably looking more in the late teens, maybe even around 2020 for some of those developments. Well, that sort of planning horizon fits right out there towards where this variance starts to become pretty wide in what I think a lot of us would consider pretty plausible cases. Bear with me. That didn't help. There we go. Oops, I went a little too far. Okay. This is where the incremental growth is coming from in demand, and no surprise, everybody knows that China is the biggest portion of that. The interesting thing to me is that the US, Canada, Europe, Japan, in this particular forecast, they all look very, very nominal. So, what's really happening, and to us, India actually looks pretty low in that time horizon in terms of their incremental growth. So the developing countries really are driving this dramatic growth in usage, and so it's really, I think as Tom alluded to, it's what is going to happen to the economies in those countries as the inflation pressure starts to take over. So we're all kind of looking anxiously at China, thinking, what is really going to happen in China with the kind of inflation that they're living with right now. I think one of the conclusions you draw from this is that the growth actually is very plausible in these developing countries, kind of with one exception. It all depends on transportation fuel. What is going to happen in transportation fuel? The developing countries will spend right now up to $90 a barrel for that incremental fuel to develop the transportation, goods, services, people from point to point. They can suffer a lot of pain to do that. The only countries that really can afford to do anything about that are the more developed countries, the US, Europe, Japan, Canada. So, what is going to happen with transportation fuel usage as we're at 90 now and possibly bouncing towards 120? And does all of this bring, as was mentioned earlier, an earlier global recession of some kind? That starts to take a lot of this away, but it really has to go to the developing countries, as I pointed out. So we take a look at worldwide supply, and everybody's quick reaction is, okay, so what's the problem? Let's just go out and develop some more supply around the world. But look, because there's 2 trillion barrels equivalent in the gas and the oil proved pie charts up there that I'm showing you. There's probably at least two times that at current prices in probable and possible. So there's lots and lots and plenty of resource, but look at where it is. It's preponderance in Saudi Arabia, Iran, Iraq on the oil side, Russia and Middle East on the gas side. Access to these opportunities is becoming increasingly limited for the major oil companies. In the midst of this existing and building supply-demand imbalance, where is the capital spending being directed? One caveat I have to make on this particular chart is the NOCs are not that transparent with some of their statistics, so they're probably a little low on revenue and perhaps capital here. But you can see real quickly there's a lot of money being spent in the United States where there's not nearly as much impact on rate and reserve growth, particularly on rate growth. Statistics, let me go on to number 5. So what are the super majors doing about this situation? Well, it looks like they're doing their fair share of the capital spending. Their capital spending has more than doubled since 2003. And yet, with all that effort, they're just barely able to keep their production flat. And then the host companies have stepped in and said, let's do a little reallocation on that because we want to get a larger share of all this benefit that's coming through with prices. So what happens to the majors, that they're not losing production, but they're really losing kind of the drive for continuing this capital spending with diminishing opportunities. Does it really, in light of all this, does it really surprise anyone how much money Shell spent on one block in the deep water on October 3rd? You know, part of the reaction to that was, look at all the money they left on the table, and my reaction was, they can't afford not to get that block. They can't afford not to get that block and a number of others, and that's what the majors are up against. Is it any wonder to any of you why they're so excited and why they're pouring so much money into the oil sands? Because they cannot get access to these projects in some of these other areas. The large independents are trying to do their part to build production with their aggressive CapEx programs. Because they're working off of a smaller base, it doesn't have nearly as much impact as what happens with the majors. The preponderance of the investment by the independents is in the United States. Smaller impact per dollar spent and smaller individual opportunities. Another issue with the independent activity is that a lot of it is focused on the resource plays. Those resource plays are much more sensitive to price, and although we're all kind of feeling optimistic about today's prices, particularly on the gas side, we've seen how volatile they can be, and these resource plays at a $2 drop in current strip prices, almost half of them develop marginal economics. The super major, as I mentioned, research and development spending, this is in real terms, by the way, adjusted for inflation, peaked in about 1998 and then took a substantial cutback and is just now coming back in real terms to historic levels of about 10 years ago. The transparency of the business, the transparency means that the transparency in the business environment means that individual technology breakthroughs aren't giving you the competitive advantage that you used to be able to, sustain competitive advantage you used to be able to get from those technology breakthroughs. Hence, the majors aren't spending as much money as they historically had. They develop a technology, they apply it, it's quickly copied within 2 to 3 years, and sometimes even faster. Now, there is obviously appropriate amount of R&D going on with the service companies. So who is stepping in to fill that gap besides the service companies? Well, are the national oil companies stepping into that? Absolutely not. So who will really step up to provide this production growth as this gap starts to widen in the supply-demand imbalance? And who has really the real opportunity to do that? It's not the major companies. Assume for a moment on this graph that the major companies and the other public companies around the world, which are the yellow and green in the bar chart, let's assume that they keep their production flat through the forecast time period of 2030, and that the increment above the yellow bar up to the top of the blue curve being the rest of the world demand, is captured by the national oil company supply, production. Then to fill that gap as it goes forward into 2030, the national oil companies are going to have to increase their production by nearly double. By 2030 in order to fill that gap. Now you say, well, they'll start letting in the major oil companies, the other large independents. They don't have, or at least we don't see the political will, the political drive, and the political necessity for them to do that. Certainly not when oil is $90 a barrel or higher. Why do they want to bring someone in to help them develop more of that? We also don't see, with the social spending requirements that they have, even though they'll continue to have excess cash, that there'll be a lot of political willpower to go ahead and roll some things back into supply development. We just don't see that. So where is that really leading all of this? Because it may sound, kind of gloomy or optimistic if you're in the oil side. To meet those supply needs, to keep it in balance, there's a requirement of about $20 trillion in oil and gas spending between now and 2030, and that's to meet the supply curve that I showed on the previous slide. Right now, the industry, including the national oil companies, is spending about $410 billion. I think that's 2006 data. 150 of that was coming from the super majors. We think that it probably needs to ramp to close to $1 trillion a year in the next several years in order to come close to meeting the $20 trillion requirement. The majors do not have access to enough opportunities to play a significant role in meeting that gap. The large independents are focused on, as I said, the resource plays, the smaller increments where they can control their risk and can control their execution. So what has to happen? The national oil companies, as I said, have little incentive and have social needs which won't allow them to happen. So what do we think is going to happen? We think it's going to flip from a supply-driven market to obviously a demand-driven market. And if the prices continue to run, then it's the transportation demand in the developed countries that's really going to have to change in order to temper the growth in the prices. That's USA, obviously Europe, Japan, and Canada. Back to a question that I think Tom raised is, what about government intervention along the way? It's very ripe, obviously, for some type of government intervention. But fundamentally, the only way around that is through a market reaction with respect to the transportation fuels. Thank you very much. I'll take questions.